It is 1:45 a.m. on Monday, September 15, 2008. In a glass tower on 7th Avenue, the lights are still on. They have been on all weekend. Inside, roughly 25,000 employees are about to lose their jobs. Most of them don't know it yet. The firm they work for has $691 billion in assets on paper. It also has $613 billion in debt it cannot pay. At 1:45 a.m., Lehman Brothers files for Chapter 11 bankruptcy protection. It is the largest bankruptcy in United States history, not by a small margin. Lehman's collapse is 4 times larger than the previous record holder, WorldCom. By the time markets open in Tokyo 6 hours later, global equity markets are already in freefall. The Dow Jones drops 504 points that day, its worst single-day drop since the September 11th attacks. Within a week, $10 trillion in market capitalization will be wiped from global stock market. This is not a story about bad luck. This is a story about deliberate choices, hidden accounting, and a leadership team that confused leverage with strength until the morning the world discovered the difference. This is the business forensics today. Lehman Brothers. Survival became part of the identity. The firm wore its age like armor. By 2006, Lehman Brothers was the 4th largest investment bank in the United States. It had $503 billion in assets and was generating record profits. CEO Dick Fuld, who had run the firm since 1994, was considered one of the most respected executives on Wall Street. In 2006, Institutional Investor magazine named him the best CEO in the broker-dealer category for the 5th consecutive year. But inside those record profits was a bet that would prove catastrophic. Starting in 2003, Lehman aggressively moved into the residential real estate market. It acquired 5 mortgage lenders, including BNC Mortgage and Aurora Loan Services, both specialists in subprime and Alt-A loans. These were mortgages issued to borrowers with weak credit, sometimes with no income verification at all. Lehman was not just selling these mortgages, it was keeping large portions on its own books, packaging them into securities, and holding them as assets. By 2008, the firm held $60 billion in commercial real estate alone, more than any other investment bank on Wall Street. The assumption was simple: American real estate does not fall nationally. It never had. That assumption was wrong. In 2008, investigators discovered something remarkable buried inside Lehman's quarterly financial reports. The firm had been using an accounting maneuver called Repo 105. Here is how it worked. A repo or repurchase agreement is a standard Wall Street tool. A bank temporarily sells assets and agrees to buy them back in a few days. It is essentially a short-term loan, and in normal accounting, those assets stay on the balance sheet. Lehman called theirs Repo 105 because they transferred assets at 105% of their value. That small technical difference allowed their accountants, under a legal opinion obtained from a British law firm, to classify the transaction as a true sale rather than a loan. The result, at the end of each quarter, Lehman temporarily moved $50 billion in assets off its balance sheet, reducing its reported leverage ratio. Then, days after the quarter closed, the assets came back. In simple terms, Lehman was presenting a cleaner balance sheet to investors and regulators than the one it actually had 4 times a year. For years, Ernst & Young, Lehman's auditor, signed off on the firm's financials throughout this period. Meanwhile, the real estate market was beginning to crack. In 2006, US home prices peaked. By early 2007, subprime mortgage delinquencies were rising sharply. In June 2007, Bear Stearns, a competitor, revealed that 2 of its hedge funds, heavily invested in mortgage-backed securities, had lost nearly all of their value. Lehman's leadership saw what was happening to Bear Stearns. They described it internally as a buying opportunity. Instead of reducing exposure, Fuld and CFO Erin Callan doubled down. They maintained that Lehman's positions were marked to market accurately, that the values on the books reflected reality. They told investors the firm had strong liquidity. What they did not say, Lehman's liquidity pool, the cash and near-cash assets it could access in a crisis, was nowhere near sufficient to cover a sustained run on its funding. On September 9, 2008, Korean Development Bank, which had been in talks to buy a stake in Lehman, walked away. Lehman's stock dropped 45% in a single day. The market had issued its verdict. Lehman was not a buying opportunity, it was a burning building. Over the following days, Lehman's counterparties, the banks and funds that did business with it daily, began pulling back. Hedge funds moved their prime brokerage accounts. Money market funds stopped rolling over their short-term lending. Every institution that could reduce its exposure to Lehman was doing so quietly, quickly, simultaneously. This is the nature of a liquidity crisis. It does not arrive gradually, it arrives all at once because trust evaporates all at once. On the weekend of September 13-14, U.S. Treasury Secretary Hank Paulson convened emergency meetings at the Federal Reserve Bank of New York. Representatives from Bank of America, Barclays, JP Morgan, Goldman Sachs and others were in the room. Paulson's position was explicit. The government would not provide a financial backstop for Lehman. Bank of America pivoted overnight and agreed to purchase Merrill Lynch instead. Barclays expressed interest in Lehman, but required a government guarantee. Paulson refused. The UK Financial Services Authority then declined to approve the Barclays deal without further conditions. By midnight on September 14th, no buyer existed. No bailout was coming. At 1:45 a.m. on September 15, 2008, Lehman Brothers filed for Chapter 11. Within hours, 25,000 employees began carrying cardboard boxes out of the building at 745 7th Avenue, images that would become the defining photograph of the financial crisis. The effects spread immediately. The Reserve Primary Fund, a money market fund holding $785 million in Lehman commercial paper, broke the buck, falling below $1 per share for the first time in its history. This triggered a run on money market funds globally. Within 2 weeks, the US government passed a $700 billion bank rescue package, TARP. The Federal Reserve expanded its balance sheet by over $1 trillion. Central banks on 5 continents cut interest rates in a coordinated emergency response. The cost to the global economy, by some estimates, $22 trillion in household wealth destroyed in the United States alone. Every autopsy of Lehman Brothers eventually arrives at the same finding. Lehman was not insolvent in the conventional sense, it had enormous assets. What killed it was a liquidity crisis, the inability to access cash fast enough when it needed it to meet immediate obligations. But here's what makes Lehman's case forensically important. Leadership confused the appearance of liquidity with liquidity itself. The mental model to take from this case is what we call the liquidity illusion. Liquidity illusion occurs when an organization or an individual substitutes a metric of liquidity for liquidity itself. Lehman's Repo 105 maneuver produced a leverage ratio that looked healthy. That ratio was the metric. The underlying reality, $60 billion in illiquid real estate assets, short-term funding that could be withdrawn overnight, was the actuality. Leadership navigated by the metric and ignored the reality. This pattern is not unique to investment banking. A business owner who looks at revenue while ignoring accounts receivable aging is navigating by metric. A startup that monitors monthly active users while ignoring cash burn rate is navigating by metric. A fund manager who marks illiquid assets at model-derived prices instead of market prices is navigating by metric. The liquidity illusion breaks when the environment changes and the gap between metric and reality becomes impossible to hide. For Lehman, the environment changed when the real estate market turned and counterparty trust evaporated simultaneously. There was no buffer. The gap between what the balance sheet said and what it actually was could not survive contact with a market that had stopped believing. Dick Fuld testified before Congress in October 2008. He said he believed, until the very end, that Lehman was solvent and that a solution would be found. He was not lying. He had been reading his own gauges. That is the most dangerous version of the liquidity illusion, when the person at the top has designed a system that shows them what they need to see rather than what is actually there. 158 years, $691 billion in assets, gone in a weekend. Not because the market changed, markets always change, but because when the gap between appearance and reality finally closed, there was no time left to adapt. The question worth asking for any organization is not, do our numbers look healthy? The question is, are our numbers and our reality the same thing? Every failure leaves evidence. We examine it. If this breakdown was useful, subscribe. A new case drops every week.